Hey everybody, Julian Marchese here. Today is September the 17th, 2013, and in this video I'm going to give you guys a market update, an update on my current positions and my thoughts on the markets going forward. So of course big the big deal right now in the markets is the Fed meeting tomorrow. Tomorrow on the 18th, it's widely expected that the Fed is going to announce a tapering of the most recent QE3 program, the extended program, the unlimited one. Where currently they are buying 85 billion per month of bond securities. So I believe half of that is mortgage-backed securities. The rest are treasuries. And it looks like that the market is expecting a taper of about 10 billion, so from 85 billion to 75 billion, which really, when you think about it, is not a big deal, considering the last move we saw from the Fed was a jump from 45 billion to 85 billion. So down to 75 billion is basically nothing. However, what's more significant is even if it is a taper of 10 billion, that means that it could be the start of a tapering program. And of course, everyone is watching this because these are the last few months of the current Fed chairman, Ben Bernanke's term. So, and obviously with the most recent news with Summers pulling out of the race, Yellen being the frontmost candidate, which is pretty dovish for the markets. Bullish for equities, bullish for bonds, obviously should be bearish for the dollar. But we didn't really see that action actually. When we saw the initial news off of Summers, we saw that pop and the market came in up. Of course, we did see a rally today. We did continue to see movement higher, but it was interesting how we didn't see sustained action, especially in the bond market and in the gold market. These two markets basically show us the fuel or the appetite for Fed Fed-driven risk. So if we see gold and bonds turning up, that would indicate that the market is expecting some sort of tapering, some sort of tightening in monetary policy from the Fed, and you'll see that in the gold and bond market. However, recently we've actually seen a pretty sizable decline since the start of the month, even in a seasonally strong period for gold. Bonds continue to be hit or down on the month, even with Summers pulling out of the race, which was thought to have probably about 10 basis points in the 10-year. As you can see, since the announcement, we have hardly seen any movement. But my positioning in front of the report, or rather the release tomorrow, is quite simple. I have a long position in equity due to technical, sentimental, and really fundamental reasons. It appears that having a long position in equity is the best stance. Of course, we tested all-time highs yesterday in the SPY, and I'm basically expecting more of this to continue. I doubt we see a pullback from these highs. It's obviously just a technical perspective. Queries are showing continued strength or continued expected strength, so I'm looking forward to seeing that as we break through. You know, the market really, especially the rate market right now, and it's very key to watch the bond market, especially how Fed-driven these markets are, of course, right now. Even with rates nearing 3%, we're sitting at 2.85 on the 10-year right now. Even with rates basically hitting 3%, the market is really comfortable. We're at all-time highs in stocks, and that's even as it seems the Fed has lost control of the long end of the curve. So that's basically telling me to buy stocks. People want to buy stocks. And this even comes with the most recent rally in emerging markets. Sorry, let me bring that up, EEM. You can see we've seen a huge rally recently, mostly short covering. And that hasn't fueled some selling in the SP. Usually what you would see is if you see a large push in a global market to the upside, you would be bearish equities, obviously depending on the situation, because you would expect that global market would pull in. You expect a pullback, which would probably hit the weaker market, and in this case, S&Ps or U.S. equity is the weaker market, and that's exemplified by the emerging market SPY spread which has seen strength recently, but it's got a lot of room to go. So we could see a lot more emerging market strength over the next coming weeks. And that's going to push us to new all-time highs in the S&P even if it underperforms. And the reason for this is quite simple. The EM SPY spread is basically a great barometer of risk. When this is going up, stocks are going up. When this is going down, stocks are going down. And that's usually just because emerging markets just have more volatility, but still continue to go the same way. So if we continue to see the short covering rally, maybe to 26 on the spread, maybe even to 27.27, we're going to see the SP at 1800. That's just the view from the emerging market standpoint. So I really like the long equities trade here with the Fed tomorrow. Should be interesting. I also like the short oil trade. I am short oil. I've been short since about 109. I got short on this day actually right here during the day, so I did see some heat on the trade, but I like it just because of C area. There was a built-in premium there. I looked to take a profit on that, but now it's also looking pretty bearish from a technical perspective, and it also comes back to the EM trade. We've seen massive strength in emerging markets, but it hasn't translated into the oil market or the gold market or the copper market, and that's also why I'm short copper. My queries, some of the queries that I ran, are indicating that when we typically see such strength in EM but such weakness in copper and oil, that tends to promote further weakness in copper and oil going forward. And the reason for this again is we expect, since equities are more rotational, that we expect the emerging markets to pull in first or to snap back first, which would cause further weakness due to the positive correlation between the two markets, between copper and emerging markets and oil and emerging markets. So that's why I remain short them. It also kind of serves as a hedge on my long equity trade, which I'm probably going to look to add in tomorrow in front of the Fed, as I think the risk, not that it is to the upside. You know, even though we're on new all-time highs right here, when we break through, every short has to cover. We're going all-time highs, and there are probably a lot of perma bears in this trade going in front of the taper, remembering last June and May, saying, you know what, let's take a short here, let's take a stab at it. If we taper $10 billion, whoa, big deal, guys. It's not going to create a massive drop in the market. So I like the long equity trade. However, should we not even taper, should we just hold, and that would be even better for my positions. That would make equities explode. I'm also holding a long call position in the bond market. So this is kind of interesting. I'll tell you my strike. I actually have, and my break even is that blue line on the chart. I bought the 106 strike. I believe it's on this day. Yeah, that is September the 27th. So next Friday, I bought a call there for 25 cents. Not a big deal. However, there's some pretty good potential for profit here. But basically, the trade is everyone's short bonds. That's a given. I do like the macro trade for being short bonds here. But when a trade gets crowded and you've got a huge catalyst like what's happening tomorrow, the release of the Fed minutes and the announcement of whatever you're doing with the QE3 program, when you got a catalyst like that, no matter your views, no matter your macro views, it's probably a good idea to take a low risk trade against the trend. Because if we see no taper tomorrow, which is a surprise, if we still see that $85 billion bond buy, you could see shorts cover really quickly. And that could create a healthy correction from this massive bond downtrend. And the profits could get pretty good if we start to getting to on the TLT like 107, 108. If we hit 107, that's 4 times my risk, 108, 8 times, and so forth. So it's a very good reward to risk trade. Low probability, but it could serve as a good hedge, as I am short oil and copper, and those are pretty much risk off trades. However, they do have definitely some different dynamics than the long equity trade here that I have. Now in the currency market, I don't want to touch it. The dollar's just at this congestion level. I don't really see much there. I wouldn't touch it at the moment. The yen, just same thing. A lot of these currencies are just in these congestion periods, and I'm gonna look for more information before I touch them. All right, so once again, guys, today is September 17th, 2013. That was my market update on my current positions and my thoughts on the markets going forward. Hope you guys enjoyed it. Thanks, guys.